Hello and welcome. This is Abhinav. In this video, I'm talking about foreign trusts created outside India by Indian residents. So, some points that one needs to consider before adopting these structures, right? Okay. So, with respect to, I've made separate video on the India tax implications of private trusts and the FEMA implications of private trusts. So that is already covered. So you can check those videos where I've discussed both the kind of legal implications on this private trust structure in greater detail there. This video is on create specific point of Indian residents creating trusts outside India. Now, what basically the thing is that a lot of times these trusts have been created, and that's why they've got a kind of a negative reputation because of uh, people like HNIs wanted to stash their black money abroad, right? So now, after there has been a sea change in the regulations with respect to maybe 10 years back, how the regulations were, and then the regulations that are now. Now you have the exchange of information agreements between, like, I think 130 countries have those agreements, and there is a information sharing that happens. There is this ultimate beneficial ownership provisions that are there, AML provisions, anti-money laundering provisions, whereby the ultimate beneficial owners have to give their details, their identification proofs, right? So basically, there is no kind of privacy, right? So if you're like creating a kind of a trust structure, you can, whichever jurisdiction you choose, Mauritius or UAE or any other jurisdiction, please rest assured that there will be no privacy, right? Because your details will be available and will be shared between countries. And if you don't share the details as required by the Indian tax authorities under the black money law, then the details, if the Indian income tax authorities receive those details um, through the exchange of information agreements or something, then it can be a kind of a, the consequences can be far significant and disastrous, right? So creating foreign trusts for kind of privacy or all those reasons are now non reasons, right? Now, if there are proceeds of crime, then there are FEMA, PMLA, black money law implications that will be there. Then there are provisions like in FEMA, there is a provision for seizure of equivalent amount of assets in India, right? So if the Indian authorities cannot reach the foreign jurisdiction to recover the assets, they can seize appropriate equivalent Indian assets. So all those provisions are now there incorporated in the various laws, right? So that is there. Then there are certain reputational risks associated with, like, tax haven jurisdictions like Panama and all these Cayman Islands and all these places. And the there is a presumption that the money that you have kind of, even if your kind of aim was genuine, but there is a strong presumption by the tax authorities that it was to evade tax. Then the onus is that much more on you to provide and provide documentation and information and in support of your contention that it was a bona fide kind of a structure that was there, right? Okay. Then Indian tax implications of foreign trusts, it is, see, for the even the foreign trusts, the Indian tax provisions under section 160 to 164, that will similarly apply for even a foreign trust only, right? So for the beneficiary, depending upon their residential status, they will be taxed on the share of the income from the foreign trust in the same way as it would have been through an Indian trust. And this has been validated in the Abu Dhabi Investment Authority case of 2021, right? So that position is fairly clear. Now, India has a general anti-avoidance rule in the Income Tax Act, which even overrides the DTA provisions. So, if you structure a transaction where the main purpose is to avoid tax, that is constituted as a impermissible avoidance arrangement, and the tax benefits can be disregarded. Then there are under the MLI that has been under as a result of the BEPS, base erosion and profit shifting action plan by the OECD. There also there is a principal purpose test provisions under the MLI that can be triggered if tax avoidance is primary or one of the main purposes of setting up this foreign trust. So the important point what I'm trying to bring here is that previously, people who have been setting up trusts for, like, either privacy reasons, which is like, for example, an Indian resident setting up who has a kind of a black money, and who then creates a trust outside India and sends the money through the hawala route, and then that particular foreign trust is like doesn't have his name. It's managed by some foreign kind of advocates and everything. So that route is now over, because now no jurisdiction will will accept a trust creation without your details, and those details will get shared. So that route is gone. Second is that for tax planning, now even for tax planning, if you do, if that's the main purpose and there are no clear bona fides, it's just that you create a structure there. There is no substance to the transaction. Everything is in India, but you try to route it through a trust outside India, that can be disregarded, and the whatever penalties may apply. And then the bigger risk is the FEMA implications that can arise, right? The bigger risk is the FEMA implications with respect to Indian residents setting up the foreign trust. So check that FEMA video uh, on private trust, where I have discussed it in detail. Now, if you are a returning NRI, for example, you are returning from US after 20 years, and you've accumulated a significant amount in your IRAs, in your 401k, in your stock investments are there. Now, US has a certain estate tax liability with respect of non-resident aliens, which is like the threshold is 60,000 USD, which is a very low threshold. Another jurisdiction, which is like UK, has certain estate duty angles. So what people do is that they then create a trust outside India to escape that estate tax in US. Now, so as per Section 6(4) of FEMA, if you are a returning NRI, come to India and you have investments outside India, you can do whatever with those investments. FEMA authorities will not question. So that's a very good provision. So that provision definitely you can check. And if you want to create a trust, say you want to create a kind of a trust or a foundation structure in UAE, and consolidate all your US assets in that structure to escape the estate tax liability in US, and you are an Indian resident, so definitely maybe Section 6(4) can come to your rescue. But still, the entire evaluation has to be done in a proper way, so that there is no FEMA non-compliance that gets attracted. Then, when you select a foreign jurisdiction, there are many jurisdictions you can choose from. So, you need to see a lot of things about that jurisdiction. What are the tax laws? How the trust income is treated in that country? What are the exchange control laws? Is there any restrictions on repatriation? What is the stability of that jurisdiction? What are the geopolitical kind of stability? Right? Is there a proper kind of a government there? Because some of these small jurisdictions, they don't even have a proper government, right? So you may decide to set up these things, these kind of trust structures in some these jurisdictions where there is some later on problem, the government is overthrown or something, and then your money is at risk, right? So all these factors needs to be checked. Then what are the regulatory requirements for the investment or the asset? For example, whichever investment that you want to pool in that foreign jurisdiction, for example, returning NRI, right? So a 401k or an IRA, so can you pool that into a trust? Now what are the US requirements with respect to foreign trust? Because US also views foreign trust suspiciously, right? So what are the US requirements you need to see, right? So there are like a triangular situation. You are based in India, the trust is there in the UAE, the assets are there in the US, so you have to see the US regulation, the India regulation, as well as the UAE regulation, right? Okay, then existence of DTA. So whichever jurisdiction you choose, try to see that there is a DTA that exists where the asset is located, where the beneficiaries reside, and where the trust is created. Between all these countries, there should be DTA, so that's a good protection. Then check the trust law, whether there is a trust law that regulates the setting up of trusts. In that, what are the registration requirements? What are the rights of the trustees vis-a-vis the beneficiaries? In some of the jurisdictions, the rights of the trustees are so much that they take precedence over the rights of the beneficiaries. So you are creating the trust for beneficiaries, not for the trustees. So you need to see, have that, have a lawyer who can guide you in with respect to the law of that jurisdiction. One more problem is that don't always rely on the entities, the basically the trusteeship companies, who are like fiduciary companies, who are like do in that business. There's always this quote from Warren Buffett that I say: never ask a barber whether you need a haircut, right? So you need to seek an independent opinion, right? So when it comes to a legal matter, seek an independent opinion from a lawyer in that country. When you need to seek a tax opinion, check with the CPA from that particular jurisdiction, right? Because see, the person who is selling you this arrangement and saying that, you sir, please create a trust in our jurisdiction, will create an investment company, the trust will own the shares of that investment company, you are an Indian resident, you can send money through LRS. No, it's not that simple. There are a lot of these factors that need to be checked, right? Okay. Then fiduciary obligations. What the fiduciary obligations are on the trustee, whether it's by law. Okay, if there is any violation, right, by the trustees, is there a grievance redressal mechanism, right? What are the Is there a regulator of that particular trust entity uh, in that jurisdiction? Does a regulator exist? Like for example, in India, we don't have a regulator for per se for private trust, right? It's just an understanding between parties, right? So in that jurisdiction, like for companies, listed companies, we have a regulator in SEBI. So whether there is a regulator that exists in that country, what is the status of complaints? Is there any pending complaints with that company, whichever you are availing the services of, with a regulatory body? All that you need to do your due diligence. Costs of setup and ongoing compliances. So you need to get a clear understanding before entering into the arrangement. What is the cost that you'll have to face, right? The cost of setting up. So they generally, they how they do is that they set up an investment company first, and then the trust is there which owns that investment company fully. So what are the setup costs? What are the ongoing costs? The investment fees that the trustees will charge, and the investment manager will charge, and the what the trusteeship kind of fees, which is again a percentage of the total funds. So you need to have a clarity. You need to see the finer print of the trust deed. If you cannot do it, give it to a kind of a professional who can check these particular provisions for you. Then any restrictive conditions in the trust deed or the investment company agreement, that fine print has to be read. Then always be prepared that in case of such kind of a planning, there will be some so generally, why you go should go for a trust is where you want to pool your assets, consolidate your worldwide assets in one trust for the benefit of your beneficiaries, or you have it in a situation where your the beneficiaries are having some special requirements, special needs, where the trust creation is a bona fide kind of a thing, right? Or kind of succession planning or asset protection. You need to have very clear bona fides, right? But there is always and always, if even if you take everything into account, if you are an Indian resident, if there is an Indian assets that are involved, right, or if the beneficiaries are Indian residents, always there will be some risk with respect to litigation with Indian tax authorities or RBI or ED. Some reduced risk. If you want to avoid every risk, become a non-resident, right? Leave India fully, become a non-resident if you want to avoid all kind of problems. But till the time any one of them is a resident, there will be some reduced risk of litigation. So the only conclusion is final conclusion with respect to this point in this video I'll make is that set up trust for the right reasons, right? Not only for tax planning or tax evasion or for privacy. No, only for the right reasons after a very careful evaluation of the risks from a legal angle. From all angles you need to verify, and no more worth setting up for privacy tax planning reasons. So this is it. I hope this video was useful. Do share your thoughts, questions in the comment section. Thank you so much for watching this video.